We now begin with our calculation of the ratios for Hindalco in our series of videos on Hindalco's financial statement analysis. And what we're going to do basically now is look at these numbers and calculate it from the data that is available there. As we have said in the past, formulae are not very important. We don't need to remember them. We always have access to tools to kind of search them, even if we forget them. It's the interpretation of the numbers that we see once we have calculated those numbers is what is important for us. So we're going to look at that, and we're going to kind of work with that as the data comes. So let's start with the set of ratios. There are about a few sets of ratios: profitability, return ratios, stability ratios, solvency, turnover ratios. We'll try and do DuPont analysis. We'll try and do cash conversion cycle calculation, and then costs as percentage of sales, and some other data points which are there, which we're going to look at right now. When we look at some of these headers, the first one is profitability, operating profit margin. OPM is operating profit margin. We divide operating profit by net sales. For operating profit, you could use either EBIT or you could use EBITDA, right? EBIT or EBITDA. A lot of the global textbooks would use EBIT. Indian textbooks, a lot of them suggest EBITDA. We can use anything. It's the trend we are more interested in. I'm going to use EBIT as well as EBITDA. So let's try and do both and see what happens there. So EBITDA is actually available here. Operating profits is available here. And I can just divide it by the net sales number. Net revenue from operations is here. I'm dividing it by the net sales because excise duty anyway is a fixed percentage that should be there. So we get a 10.5, 10.9% kind of a number. If we remove depreciation from this, we are going to get EBIT. So I can basically put a bracket on the top and subtract EBIT from this, subtract the depreciation from this to get the EBIT, right? So that's the depreciation subtracted. In fact, we have EBIT calculated there. So no point really going down that route. We can just take the EBIT number from here, that's row 27, and divide it by the sales number, which is 7202. So that gives me the net operating profit margin. I'm using EBIT now, so we can use EBIT there. Net margin or net profit margin is nothing but net profit by net sales. So I'm going to go right down to the net profit number, which is here, profit for the year, and divided by the net sales number. This number actually is also available on our vertical analysis. So that's the number we're looking at, right? Profitability is kind of done. Let's do the calculation for each of these for the first year, and then we'll just drag it on the right side to understand what's happening, right? Next, we move on to the return ratios, which are important in the context of understanding people who have given money to the firm. What is the kind of return the firm is generating on their money, right? So when you look at something like return on equity, the primary idea is shareholders are entitled to keep the profits of the firm in the form of dividends. They choose to reinvest this money in the form of shareholder equity or reserves and surplus. If the company consistently does not generate a return that is greater than its cost of capital or cost of equity, there's no real point in terms of the firm keeping that money. It should largely return that money to the shareholders, right, in the form of dividends. So is the firm able to have a good return on equity premise? Let's look at that. So we're going to take the net profit, which is here 2457, and divide it by the total shareholder equity. So I'm going to divide it by the sum of, on the balance sheet you can look at a few things here, and I'm going to add these data points, whatever are the total shareholding data points that are available. So we're going to look at that, and we're going to get this here. So this works to about 8.5% or something. I can let's format it accordingly so that we have the same. Then we look at return on assets. Now you note that the formula changes a little bit. The formula uses a term called EBIT and not net profit. And why is that? Is because any ratio, for that matter, is going to be a combination of a numerator and a denominator. And there is a premise called consistency premise in ratios, which says that if the denominator applies to the equity holder, then the numerator should also apply to the equity holder. But if the denominator applies to equity plus debt holder, then the numerator should also apply to equity plus debt holder, right? So when you look at return on equity, for example, you see net profit by shareholder equity. That's because both of these terms apply to the equity holder. But when you look at return on assets, right, your assets are essentially going to be for both equity and debt guys. When the firm sells the assets, the claim is for both the equity and debt guys. So in the numerator, you need a profitability measure which includes profits for both the equity holders and the debt holders. So it should include the interest component. Simplistically put, you could also do net profit plus interest divided by the total assets of the firm. That should also work. But because tax is a fixed number, we just take EBIT straight away. So the same argument also goes for something called as return on capital employed, which is what is the amount of money that has been put in by all stakeholders in the firm, and what is the return that they're generating, which is the EBIT on that, right? So that's the broader premise in terms of how these formula would work. Let's divide the EBIT in this formula. So we get to EBIT, and for 2011 that EBIT number is here, and we divide it by the total assets on the balance sheet. Total assets would be the same as total liabilities. That's the total assets, right? The next one is EBIT once again, and divided by, now it gets divided by the shareholders' equity, which is share capital plus reserves and surplus plus warrants plus any minority interest, anyone who has the stake in the firm, because this may not have been removed by now, plus the loans that the firm has. Now, in the context of loans, we could choose to use long-term as well as short-term. Here, I'm going to use only the long-term loans in our discussion. But if you think that there is a big movement in the long-term and short-term debt that is happening, you can use total debt. Here, what we have done is we have used what is called as long-term debt only. Shareholder equity plus long-term debt plus minority interest that comes here, right? So that's the broader formula that we use for calculation of this, right? Next, we move on to debt by equity. Again, you can use long-term debt by equity or total debt by equity. So let's start with long-term debt by equity. And that's basically your debt, which is here, loans, divided by the sum of the equity data points, which is here, right? So that's 0.87. If you use long-term plus short-term debt, both of them, then obviously the number might change a little bit. Further, you see something interesting, which is called as debt by tangible equity. Right now, it says tangible equity in the formula as equity minus goodwill. What does that mean? When you look at this balance sheet, what does this equity number suggest us? For any company's balance sheet, what it basically tells you is that if you sell all the assets, you will get 84,870. From this, you have to settle all the liabilities, which are external liabilities. And then what is left is for the shareholder, right? So that's what is left for the equity holder. So you are basically looking at a clause of saying that sell assets, pay liabilities, and then what is left is the equity guy's claim. Right now, there is a problem with sell assets. Is assets have to sell at the value they are getting created or they are being reported on the balance sheet. Now, usually most of the accounting is conservative in nature, but assets have to sell at the value reported in the balance sheet. Now, when you look at the assets, all assets are fine with the exception of intangible assets. And even within intangible assets, we are more concerned about this asset called goodwill. So let's quickly understand how goodwill gets created. Let's understand this, that if there is a company A that acquires a company B for, let's say, 1500 crore rupees, and the assets of company B are only 1000 crore, then in the combined balance sheet, there's going to be a mismatch. Outflow is 1500, inflow is only 1000. So to adjust this, you create an entry called goodwill of 500. So 1000 worth of assets come in, goodwill of 500 and minus 1500. Note that this has come only because someone has decided to overpay for the assets that exist. Now, overpayment could be because of brand value, because of an understanding of some synergy that the company might be able to generate out of this entire exercise. But there has been an overpayment for sure, and that's basically what it looks like in terms of this construct. So effectively, what happens is when you report goodwill worth 500, it is assuming that if you were to sell this asset again, if you were to sell this company B again, you're still going to get 1500 in the market. Now that may not be true because that entirely depends on one, the degree of overpayment that you have done, and two, what is the broader construct that someone else, whether they will derive the same value out of it or not, right? So effectively, that's the crux, that's the discussion that is there. So ideally, when you're looking at assets, if you want to be really conservative and there is goodwill, you want to sell the assets, but you're not sure if you will recover the goodwill, so you remove the goodwill and then you calculate the debt equity kind of a ratio. So and assets minus goodwill will basically mean all other liabilities are fixed, so you are eventually going to take out goodwill from the equity portion. Assume goodwill is zero, you will assume that you are not recovering that value. You will basically find that equity has to go down by that amount, correct? Because that's the equity holder's loss. It's not going to be the loss for the debt holder. The debt holder is going to make whatever they have been promised, correct? So let's go to the Excel file and try this out. What we do need to try and find out if this entire amount of intangible asset is primarily goodwill, right? There could be some other intangible assets like patents or software, etc. So in the last few years, you will note that the number has been put in. This 17,000 odd crore is the goodwill. We can try and check for some of the earlier years. What we need to do is probably go to the annual report from the investors section. So click on reports and presentations. Click on, let's say, the annual report for something like 2015-16. And if we go to the consolidated statements here, we'll get a sense on what the goodwill number would be. So if we look at the total intangible assets, that's the data around intangible assets is given in note number 16. So we'll have to go to note number 16 and try and check out what are these intangible assets that are available. And that's the note number 16 that we have. And if we look at this closely, let's maybe rotate this. So we find note number 16 here. We will note that the goodwill on consolidation is going to work out at around 14,000 crore at the end of 2016. And then there are some other data points which are there which play out. Now, what's interesting is that if we go and look at the reports and presentations for 2017, there has been a change in the reporting parameters, the way you report some of these data points such as goodwill, etc. And when we look at this, we will realize that probably that number is slightly different. So when we look at this, and let's say we go to the consolidated assets and liabilities, that's the consolidated number. And if you look at the goodwill number here, that's available here, that's the goodwill number. That's around 17,000 crore for this year, and it's equally 17,700 for last year. So the way goodwill gets reported has changed a little bit as compared to this annual report, which said at the end of 2016 goodwill was 14,214. That number has changed a tad. And so when we go back here, we are assuming that approximately 17,000 crore is the goodwill number, and that probably has would largely mean that around 85% of this number is goodwill, right? So what I can generally do is put up a header here and say if, let's say, whatever the number is, 17,700 odd crore here, let's put those numbers here. So this is 17,134 and 17,735. 17,134. Whatever this percentage is as a percentage of total intangible assets, around 83%. I'm going to assume that this 83% is going to be uh, the goodwill number. So 82% multiplied by my intangible assets for previous years. That's because last few years we don't have this data available. And so that's why we are calculating goodwill in this kind of a format. And we're trying, this data would be available, but it probably is not it's not stated in the current format. So just to kind of bring it to current accounting standards, we are basing it back in terms of 82% of the total intangible assets being goodwill. Right now, I can go back to the ratio sheet and calculate this as on the balance sheet, the long-term debt, whatever is the long-term debt, that's this. And I should honestly add other financial liabilities to this because that is also long-term debt. In fact, we need to make that change in the previous formula. And we can divide it by the equity, which is the sum of the equity numbers, which are these three. And we need to subtract the goodwill number, which we just calculated. That's here. So I can subtract that, and suddenly we see that the numbers change, right? And here also we need to add in this, let's add the formula around the other long-term, other financial liabilities, which are the current portion of long-term debt. And I'm going to put an enter to that. That's the difference. And we note that the moment you remove goodwill from our discussion, it becomes very interesting to look at things, right? The next data point, that is interest coverage, and this is also an important yardstick in our overall analysis of this company. So EBIT by interest is the way it is calculated. So a straightforward calculation would be if I go to the EBIT and I just divide the interest number. Now, a number of beyond 3 is usually considered as a good number. It's a safe number. So the company seems to be okay in terms of their repayment capability of EBIT divided by the interest when we look at that in the context of this company's analysis, right? Now, that's it with the first 3 set of ratios, which is profitability, return ratios, and stability ratios. What we can do is we can just drag these on the right side to understand what's happening with the firm over these years till 2017. And we will note that debt equity has gone up, interest coverage has deteriorated considerably, right? It's gone down. Operating margins and net margins, operating margin and net margin is better in this year, but previous years, when we look at EBIT, that's not done too well. Return ratios have gone down dramatically, started at around 8 to 10% kind of levels for the first few years. But then since then, the company has not kept pace with the amount of money it has generated, at least for the shareholders, right? Return on capital employed is kind of okay, just improved last year. But again, that had fallen from 7 odd percent, 6.5% to 4% over these years. So we will look at decoding these numbers a little bit more. But what immediately comes to our understanding is just looking at these plain numbers itself says your interest coverage, your interest coverage has deteriorated, and it's deteriorated primarily because your operating margins and net margins, there's nothing left after removing all the taxes and everything. So obviously there's very little money that you're making. Debt has increased, right? And that's possibly because the company did expansion using all this debt, has not been able to repay considerable amounts of debt, but nevertheless has not done well as well over these years. It's just started improving its performance a little bit, right? Return ratios, with the exception of 2017, have been continuously declining, and we may want to kind of check why is this happening. right? Why are these numbers declining? For that, we will do further analysis of these numbers when we go ahead and look at some of the other ratios. That's it in this particular video. In our next video, we're going to look at the other ratios and do a little bit of analysis around why these numbers are moving the way they are. And have we actually calculated these numbers correctly in the first place? Do they represent the company's current financial status correctly in their traditional format in the formula that we've calculated, we've used for them, right? That's it in this video. Thank you.